Mid-February 2023, Intel announced it would be cutting its quarterly dividends by 66%, sending the stock price down by 11% in 1 month. The stock price is also down by nearly 50% from its 52-week high. Is the price drop due to the cyclical nature of the semiconductor industry? Can the US CHIPS Act save Intel and give it an edge in the market versus Nvidia, AMD, and Taiwan Semiconductor? And if so, is it time to buy the dip and hold shares for an eventual recovery? Let's find out. I'm Hoda Meir, founder and CEO of StockCard, and I love buying the dip. Intel has been popping up on my buy the dip screener lately, making me wonder if the stock is fundamentally solid to buy and hold at a reasonable price now. After all, Intel was once the pride of semiconductor industry in the United States. It was co-founded by Gordon Moore in 1968. He's the man behind the Moore's Law, which is the foundation of the extraordinary growth the world has enjoyed from the advancements in electronics in the form of smartphones and computers. Investors in Intel have benefited from its unquestionable head start in the industry with a 61,000% growth between its IPO in the 1970s and today when I'm shooting this video. It also managed to keep income investors happy with its reliable dividends for decades. However, not only has it cut its dividend by 66% in 2023, but it has fallen behind semiconductor companies such as AMD and Nvidia and lost large customers such as Apple in recent years. Some investors argue that cutting the dividends is a good sign that the management is allocating its capital to grow. Others are excited about the US CHIPS Act, which is expected to provide financial support to companies such as Intel that bring back semiconductor manufacturing to the US. Today, I'll dig into the company's fundamentals, review the impact of CHIPS Act on Intel's future, and finally conclude whether it is worth buying shares now. I'll use the StockCard platform to research the company's fundamentals. I'll recommend you pull up its StockCard and do your own research along. Creating an account is free. The link is in the show notes. But before we start the research, let me remind you that I'm not a financial advisor and this video is for education only. You should do your own research. And remember that investing has risk. You can do all the research in the world and still lose a lot of money. That's the nature of this activity we call investing. And now, let's find out if Intel can be saved. I took a quick look at the company's top and bottom line in Q4 and fiscal year 2022 versus the previous year, and I had a chill down my spine. The company's financial performance is a picture out of a horror story. In Q4, revenue was down 28%. And earnings per share were down by 92%. In fiscal year 2022, revenue was down 16% after some adjustments due to exiting memory business, and earnings per share were down by 65%. But revenue and earnings fluctuations in isolation don't mean as much. I pulled up similar numbers for Nvidia and AMD to contextualize the numbers. Nvidia's revenue remained stable in the last fiscal year, and the earnings per share were down 55%. The horror story intensifies when you compare Intel with AMD, whose fiscal year 2022 revenue jumped 22%, excluding the impact of Xilinx acquisition, and earnings per share were improved too, also excluding the impact of Xilinx acquisition. Although both Nvidia and AMD have gone through a similar challenging year for the semiconductor industry, their performance isn't as terrifying as Intel's. As you read through Intel's annual reports, there are three primary reasons for its horrible performance. First, market demand is slowed down, especially after a big surge in personal computer and data center demand during the pandemic. Second, exiting from memory business and 5G phones that decreased overall revenue. And third, the cost ramp up due to technology development catch up, especially in the form of significantly higher R&D and capital expenditures. The demand issue is understandable and should get sorted out as the demand stabilizes in the coming quarters and investors stop comparing the business with its historical revenue, including the historical revenue from the lost memory and 5G business units. The question is whether the R&D expenses and the capital expenditures pay off and whether the company can win business from its competitors such as AMD and Nvidia. The problem for non-technical investors like me is that I have no clue. Intel claims that its new products expected to be released in 2023, 24, and 25 will enable the company to gain market share. Other technical reports suggest there isn't much to be gained from these product releases because the company is still behind its competitors in the more lucrative market segments such as data centers. Who do you believe? I'd say no one. The hard truth is that we won't know until we see the results in the number. We won't know until the product is released and we can see the early signs appear in growing revenue, new customers, or improved margins. There is a caveat to that. In the past videos, we've discussed a similar situation. For example, we discussed Meta, formerly known as Facebook, which is pouring billions of dollars into R&D while the company isn't growing rapidly and faces competition from TikTok. In that scenario, we relied on Meta platform's historical track record in turning R&D dollars into results. I'll leave a link to that video in the show notes if you want to watch it at a later time. However, in the case of Intel, we have the opposite track record. The company has been delaying its new generation Intel 4 product launches for many months and years. Even before that, and before the current CEO, the leadership resisted investing in R&D, allowing competitors to take over Intel. Even worse, the company just made rather quiet announcements at the beginning of March to discuss a 2-year product release schedule in its data center business unit. Again, as a non-technical investor, I don't know if that's really bad news, but no product release announcement on a quiet Friday afternoon mid-quarter is good news in my experience. I know that's not as satisfying as giving you a concrete answer, but even technical folks won't be able to give you a better answer. And even a technically superior product may not perform well in the market. It takes time to ramp up, and Intel promises 5 new generation product releases in a matter of a few years, whereas similar product launches have taken competitors a decade or so to develop. Typically, in situations like this, you imagine the worst case scenario and then decide whether the company can live through the worst case scenario and eventually win. This means as our next step, we should look at the company's cash position and see whether it has enough cash and not too much debt on its hand to be forced into taking extreme measures. Let's dig into Intel's cash position versus liabilities. Intel sits on a huge amount of $38 billion in cash, but then it carries $80 billion in liabilities, deflating our excitement over its cash position. The situation isn't as grim because aside from cash, Intel has enough assets to cover its liabilities, putting its debt to equity ratio in an acceptable range. But the picture isn't rosy. Intel won't run out of cash, but it also doesn't have a significant cash balance to keep investing in R&D and building manufacturing facilities if the dollars won't turn into sales sometime soon. And then comes the issue of valuation. The stock is priced at 1.7 times sales and 13 times earnings. Neither is too high, but then there's still the expectation that the company can grow its revenue by 70%, hence the 1.7 price to sales ratio. Those are reasonable assumptions for a chip manufacturer with a market lead because we see a similar price to sales ratio for Taiwan Semiconductor and a much higher price to sales ratio for AMD and Nvidia. However, they may not be reasonable valuation ratios for a company that needs to play catch up. So here's what we learned today about Intel. Intel's revenue and bottom line decline are larger than its competitors. The company has increased its R&D investments and capital expenditure, but its historical track record doesn't guarantee that the R&D dollars will turn into results soon enough. Third, the company has lots of cash, but lots of liabilities too. The situation isn't dire, but if Intel needs to keep investing in R&D, it may be unable to fund on its own for a long time. And fourth, the valuation is reasonable, but not extremely undervalued. Investors already have some reasonable growth expectations baked into the price. Bottom line is that Intel needs a lot of money to grow into even its reasonable current valuation. And that brings us to the CHIPS Act. One of the core projects Intel has been working on is to develop its chip manufacturing capabilities, also known as foundry services. Semiconductor companies either design their chips or manufacture them for others. For example, AMD or Nvidia are chip designers. World's largest chip manufacturer is Taiwan Semiconductor, which manufactures chips for others using their design. Intel wants to compete with both chip designers and manufacturers, and it doesn't have a lead in either. This means significant investment in talent, technology, and large and expensive manufacturing facilities in the US and the EU. The only other company I know that has been able to replicate a similar strategy successfully is Tesla. It designs its cars and manufactures them too, and we have seen Tesla's multi-year struggle with raising capital. Hold on Tesla's comparison, and let's go back to the CHIPS Act. This government program is supposed to provide grants and loans to chip manufacturers. However, it has a maximum cap of 35% of projects' capital expenditures. CHIPS Act won't be free money and won't cover all the capital requirements by Intel. Intel still needs to raise its capital to fund these massive manufacturing facilities. We can argue that Tesla pulled it off, but then compare Elon Musk with Intel's CEO. Tesla has built an aspirational brand. Customers are willing to pre-order their products, and investors pay up to be associated with the brand. Best engineering talent gave up 24 hours of their daily lives to make Tesla successful, and it was still very likely that it could have failed. I don't see that visionary brand and persona by Intel, and I believe it will take more capital than Intel has now to bring the vision to reality. And the government support isn't free money and has a ceiling. The bottom line is that the case for Intel's turnaround and recovery is difficult to believe due to the lack of evidence. As a long-term investor, I've learned that if a company is solid and the stock price is moving in the right direction, I'll have a few years to invest in that stock and still benefit from it. Intel's survival is questionable until I see evidence of growth and turnaround. Now it's your turn to pull up Intel, AMD, Nvidia, and Taiwan Semiconductor stock cards and decide which one you'll bet on. I'll leave a link to all of them in the show notes. If your conclusion about Intel is different from mine, share it in the comments so we can learn from each other. I'll see you next time.